brokerage team to provide the highest level of professional service at all stages of our clients' investments. Our team has decades of experience in all types of markets, guiding clients through some of the most challenging times for investors. Our all-hands-on-deck approach generates more offers on your listing, and according to CoStar, we have sold our listings faster and with the highest list-to-close percentages over the past 2 years. For buyers, we identify and negotiate the best terms possible, ensuring your long-term success. We hope your time with us today helps your passive investments become massive investments. Centennial Advisors, here for you now and always.
Good afternoon, everyone. I'm Justin White, Managing Partner of Centennial Advisors. Thank you for joining us today on our webinar. I'm now back with my regular guest / co-host, Jason Brooks of Buckhalter. Jason, it's nice to have you back after a month sabbatical that you had. You got to enjoy a vacation, miss a webinar.
Thanks for having me.
But great to have you back. You know, we're going to talk about the headlines today. But the first thing I wanted to know is, Jason, as a Southern California guy all your life, are you on strike right now as a actor?
No, I'm not. I think that's a route in life I chose not to go.
I thought maybe in a previous life you might have been in a movie or something and had your card. Most people in Southern California do. So now that we've got that out of the way, that's actually maybe our first, we'll call it a super local headline. Only because as I was listening to KFI this morning, I heard that, you know, the potentially the talent side of the equation in Hollywood is going to go on strike in support of the writers. And the other side of the coin's comment was, well, they're going to need to get back to work because they're going to have to pay rent. What do you think a prolonged writer and actor strike does to the, well, we'll call it the rental market in LA and around the area, but just the overall economy in Southern California?
I don't think that it has a massive effect on the, let's say, apartment rent. I think where it has a bigger effect is the commercial side, either, you know, vendors that service the industry a lot. I mean, from the catering companies to, you know, people that are operating businesses that help, and then the commercial spaces, that sound stages that are private and things that might be leased out that are no longer needed. A lot of those sound stages and things, for example, get leased out on shorter term deals, and they're usually really busy. But all of a sudden, if, you know, no one's working, I think commercial spaces and commercial and businesses will be affected more. I don't think, I mean, we have there's how many millions of people that live in LA County, right? And what small percentage of them are actually, sorry, what?
It said lots.
Yeah,
lots
I think it's like 8 or 10 million people. I think it's like 8 million people that live in LA County or something like that. And a tiny fraction maybe work as writers or actors. So I think at the end of the day, a lot of those actors too are doing things like being waiters and waitresses, or, you know, other ways to make income. So I think that that's less affected than the commercial side.
Okay. Yeah, I just thought we're talking about headlines, and that was certainly the first headline that I heard when I was listening to the news this morning while driving into the office. What we're going to do today is we're going to pull up, we've got some slides, we've got some headlines that we've pulled from around the real estate world of different things that we've been seeing. We'll read you the headline. We'll kind of talk about it a little bit. You can read some of the stuff we've got on the slide or the graphs that we've got to support it or kind of discuss. And if you've got questions at any point on any of the headlines that we talk about, or on anything else related to commercial real estate, we will certainly give it a try to get that answered for you. Real quick, going to read you our new disclaimer that the content of this program is for general information purposes only and does not constitute legal or professional advice. The opinions expressed are those of the presenters alone and do not necessarily represent the opinions of the Multnomah Bar.
It should. I think, Justin, it should not represent the opinions of Buckhalter or Centennial. I think we might have left in some other companies from other presentations that this slide might have been used on.
Oh, well, thank you very much. So we will get to the first of our own opinions. The headline: soaring insurance costs could paralyze CRE. So investors are calling for reform. Jason, you're probably somewhat on the front lines of that for clients that have insurance claims, that have different issues. Just talk a little bit about kind of what you're seeing and what you're hearing from your clients as it relates to, we'll specifically talk insurance costs and then maybe get into some of the other expenses that we're starting to continue to see go up.
Yeah, so this is something that I think affects everybody, but this too. I do a lot of the high-end residential properties, and this has been an issue for a while, is getting fire insurance, if you could get it, in the cost of fire insurance, and the soaring cost of fire insurance. And now it just has kind of trickled down from fire insurance to all insurance in general, where it's really difficult. And if you can, it's unbelievably expensive. We have a mutual contact who's moving, back to California from out of state, and the person's talking about renting, and they're renting a house down in San Diego. And the person told me, man, you cannot believe the cost of insurance, because I have to get insurance for the home as the renter. And I was like, and this person sold a house for, let's call it 8 figures in Newport before they left, and just 2 years ago. And now they're saying the insurance costs on a much less expensive house are 2, 3, 4 times as much. So it's affecting everybody, and there needs to be a solution. So,
yeah, we see it in all the underwriting that we do now. I mean, insurance probably somewhere between 25 to maybe 45 cents a foot 2 years ago, depending on product and age and all of that stuff. And the increase is certainly significant. We've got a client who reached out to me the other day. First time in 20 plus years of being in the business, when I said, well, why are you considering selling? The cost of insurance. They've got a large multifamily property where the insurance was $60,000, $70,000. And they're staring at a quote that's $330,000, starting in February of 2024. On that size of a project, yeah, they could probably eat it, but I think, it kind of speaks to what we've been seeing and what we've been talking about for so long, which is just that so many expenses are going up, or costs are going up. Meanwhile, from an income standpoint, some of it's been pretty controlled or regulated, and people are not able to catch up or stay ahead of some of the increasing costs. I think. Well, go ahead,
Justin. Think about if you own RS and rent stabilized property in city of Los Angeles. So LA City RSO is the rent control. You haven't been able to raise rents in 3 years. And granted, when you can raise rents, it's like 3%, right? And if you've had someone that's been in there for 25 years and their rent is really low, you are losing money most likely on that unit.
Well, yeah. And, it's anywhere from 90 to 107 degrees in Southern California today. The utility cost, and, for the tier, whatever it's going to be, and the heat wave, surcharges and all that stuff that goes along with it, just more and more. Utility costs are just going up in general. And some of those costs are getting to be exceptional. You had mentioned it a second ago. You talked about RSO and not being able to increase rents, which kind of leads us to another thing, which might be where people are still losing money with, tenants not paying, and some of the challenges that came from managing property during COVID and eviction moratoriums. Talk a little bit about how are some of your clients doing? Are we starting to see more ability to get the wrong people out of property? How long is it taking? Are their costs significantly higher or the same? Talk a little bit about that and what you're seeing.
So we'll kind of break it down into LA County and then everywhere else. Everywhere else is great. If you have tenants that aren't paying, if you have tenants that are being difficult, we are successfully and consistently evicting people out of buildings. We've multiple times in the last 12 months vacated entire buildings in 60 days. And I'm not talking about like a 4-unit building. I'm talking about a 16, a 22, and a 30-unit building. We vacated the entire building. We did those under, AB 1482 substantial remodel. But then we've had, a lot of success when people aren't paying rent. People are being nuisances. They're harassing other tenants. And we've had success in getting those folks out. That process is anywhere from, 30 to 90 days generally. LA County is still difficult. LA County is always difficult because LA County really wants to favor the renter. We have been getting people out successfully, and city by city basis, it kind of depends. A lot of people in LA have started to do not the bigger commercial owners, but smaller owners have done owner move-in evictions a lot recently, where their kids moving into the unit now, or family members moving in. That's had a lot of success. So we are getting people out. It's just a little bit more of a headache, and there's the protections are gone, but now people are just going back to the old tricks to try to drag things out.
So substantial remodel, you're going to circle back to that one. Sounds like you've been involved in a couple of those lately. Talk through that. Talk about, give some suggestions on maybe the best way people can do that. Because what I hear when I mention it or talk about it is people are concerned, well, how do I make sure I do enough? Or, what is enough to be able to feel like it's not going to come back to bite me if I go in and do some work to my unit?
Sure. So there's no dollar amount specifically you have to spend. And a lot of people ask me, like, do I have to spend $10,000 or $20,000 or $5,000? You have to touch what is referred to as a structural system. I oftentimes talk about structural systems on, new construction defect law, but you're often talking about plumbing, electrical, foundation, framing and roof. Those are some of the big ones. And so for what we often tell, and it has to take more than 30 days. Well, for the most part, because of how busy construction crews are and the availability of labor and, parts arriving and delays, it takes over 30 days. And so generally I say, if you're going to remodel the unit or do work in the unit, do work in the bathroom, right? Change the fixtures out to low flow because it saves money anyways. And, do some things in the bathroom with fixtures, and because that gets you your, plumbing system, which is a structural system. And then I always recommend, it is not required, but I always recommend that you pull a permit. Remodel permits are very easy to get. They're not expensive. The approval process isn't hard. When you touch a structural system, you're supposed to pull a permit. Some people don't, but you're supposed to. And so therefore, by pulling the permit, you're showing I'm touching the structural system, which is a good defense if anybody comes at you in the future.
Fantastic. Super insightful there and appreciative. I think that's it's going to improve the property, improve the quality of the housing for residents in the future, and allows somebody to, take care of the necessary items in their property so it can always be easy to manage. And so thank you for talking about that one. You did mention another one, and I got a call today from a buyer who was interested in a property and was proposing to move into one of the units in order to get a tenant out. Talk a little bit about that, if you can, what unit you have to go in, if there's any restrictions on that, maybe how long you have to be there, like what are the best practices to effectively use that one to improve your property?
Sure. So I'm going to talk generally about this because a lot of the cities have their own specific rules. I don't have all of them memorized. It's a very common thing right now in West Hollywood because West Hollywood has these really great duplexes that are essentially like 3,500 square foot houses each, but it's a duplex. And so people are buying one to move into and then maybe moving a family member into one or renting the other one out. But high level, it needs to be you and or a family member. So children, grandchildren, brothers and sisters, parents, grandparents, aunts and uncles, nieces and nephews, but like bloodline, not like, Justin, you're like an uncle to our son Ford, right? Like that wouldn't work. But bloodline related family members works. They're generally supposed to stay there for 2 years. If you put the rental property back on the market after 2 years, you're actually supposed to offer it back to the original tenant. That's a general rule. Now let's talk about how you pick the unit. So you first pick the unit that fits the needs of the family. So if you're an individual single male or female owner and you want to move in saying, I want the 3-bedroom, is probably not the best idea. Maybe a 2-bedroom's arguable, but the 3-bedroom, probably not, just because it doesn't fit the situation. So you need to pick the unit that kind of fits the situation. And then from there, is there a vacant unit available first? You have to take that one. And then generally, if not, you go from who's been at the property the shortest amount of time to the longest amount of time when picking the unit. So you have to get the person out that's been there the shortest over someone that's been there longer. And that's generally how it works. One thing to note is there is no limit to how many family members you can move in. I mean, you couldn't move in your 6-year-old child into a 1-bedroom unit, right? Because they can't rent their own property. But like if you have a bunch of, I actually have a client that bought a 9-unit building in Hollywood, and it was newer construction. They evicted everybody and they moved in their entire family, right? Like it became like a family compound. So, the aunt and uncle had this one, the grandparents had this one. They lived in a house nearby and they put their kids in these ones and they did it that way. And you can put in as many as you want as long as it meets the criteria. So you're not just limited to one OMI eviction per property.
Okay. I was going to ask you. So I could move into one, and then I could move a adult family member into any number of other units at a property.
Correct. So yeah, you could move in, your dad into one, your mom into one. You can move your brother into another. You could move, any of your wife's, siblings or family members into them.
Okay. And then you had mentioned, you said, if, so you plan, you're going to move in, you're going to be there for 2 years, whatever the minimum requirement is, plan on meeting that, but life happens and there's some circumstance that comes up and you move to Texas. When you move to Texas and it's been 1 year and 3 months and you call the tenant that was in there before, like, what if you've done a lot of work? Do you have to offer it to them what their rent was before? How's that work?
Generally, you're supposed to offer it to them back at whatever they were paying. You could probably factor in a reasonable increase from the prior year, but not I took the unit and turned it from a $1,500 unit to a $3,000 unit, right? By doing work like that part won't work. Generally speaking, I will say most of these tenants have found other places. They've moved in, they've signed longer term leases, right? So kind of a thing to keep in mind is people generally sign 1-year leases. And so, if you've been in the property for 11 months and you're like, I might be moving now, and then you let them know and they really like the property and their lease is up in a month, that's one thing. But if it's been 16 months and they're 4 months into the second year at their new place and they've got 8 months left and they don't want to break the lease and deal with that other landlord, they're less likely to accept it. So, because remember, they still have to get out of their other lease.
Some people do that sort of stuff, is what you're saying?
Sometimes. I mean, here's the thing though, like you have to have the intent to stay for 2 years, right? Like if you have a real change in life circumstance, fine. But if you're sending emails, right after close, right before close, a couple months from close, being like, I'm remodeling this thing and I'm getting out of here, right? And you ever get sued over it and there's an investigation, that email is going to be found and you didn't have the intent and then you're in trouble.
Fantastic. Good insight on how it works and what happens, as well as really good suggestion on how to protect oneself and not abuse some of the provisions that we do have. Let's move on to the next headline.
Justin, on that slide you just had up really quick, it's important to note when you're looking at those properties, a lot of the places where the insurance increases are occurring are places where they've had major losses in the last few years. Generally, the only thing that can cause a loss for an insurance company of that magnitude is, natural disasters or events, right? So California, much of it is being blamed or has to do with fire. And then you combine that with the lack of enforcement on crime, right? So property damage, et cetera. Whether it's, letting people break stuff and loot or other things. Texas, when you look at South Texas, it's hurricanes. Same thing with Florida. That part of Florida where you put the Bainbridge property was where it got hit really badly by the hurricane last year. I actually had some clients that bought properties in that area right before and were in contract when it happened. And their insurance rates went way up, at the closing. So that's what the argument is of why it's driven. I think that there are certain parts of the country that aren't seeing those increases. I just think it's important to note, kind of like, it's not even all of Texas either, for example, right? It's just the dot on the map is Houston, for example. So,
yeah. And I think that is a good point, is that, it is not everywhere. And it is natural disaster driven. Next slide. This one comes from CoStar and their rent tracking. It's basically the last 18 months of the average asking rent in Orange County. And you can see that from September kind of down through March and April, asking rent going down just a little bit, all kind of between the $2.85 and $3 foot range, but now on the way back up. I know that you've got a tremendous amount of clients that have heavy apartment portfolios. Talk for a second, maybe just on what you're hearing about operations, and then I'll make a couple comments that this graph doesn't really surprise me based on what we're seeing.
Yeah, I think that there's still a massive housing shortage, right? And so with a lack of supply and a high level of demand, it's going to continue to drive pricing up. And I do think, as I'm not going to say the economy has slowed down. I think everybody's well aware of it, and with that being said, you tend to get more renters in situations like that, which means you're increasing the rental pool. You're not, therefore you're increasing the need and the demand without increasing the supply. So this is fairly straightforward. And I think it's good to see in common. I will say one thing about rental increases while I have the moment here. So AB 1482, you use the April CPI for your factoring in of rent increases. So it's 5% plus the April CPI. You have until August 1st. So from April CPI comes out beginning of May. You have May, June, July to decide if you want to use last year's CPI or the current year CPI. Starting August 1st, you have to use the current year CPI. Important to note, if you get your rental notices out before August 1st, the last year's CPI was north of 5%. So you can get a 10% increase. This year's, I think, was 3.8. So you can only get an 8.8% increase. So if you really want that extra 1.2%, you have about 17 days to get your rental increase notices out.
Question on that one for you. Do you have an opinion? So if I get my notice out, let's say I'm not going to increase somebody's rent till November 1st, but I get the notice out tomorrow.
You can't give the notice tomorrow. Like, you would have to, if you had someone on month to month and you haven't increased it in the last year, you can get it out now and it would go up September 1st, but your notice is out on time. You couldn't give your notice today for a November increase.
Okay.
That's why I often, if you can, recommend doing your notices now. If you're a 1482 property, doing your notices sometime between, June, July is a really good time, because you can kind of look at both numbers and decide what you want to do.
That's a really good one. I hope everybody writes that one down.
Also, people don't want to move during the summer because it's hot and miserable to move. So, and people don't like moving around the holidays either.
What's interesting about this graph, you talked about interest rates going up and, people not being able to afford housing. But I think what's also driving it up is that interest rates have slowed down the amount of sellers in the residential market. People that have their 3%, 4%, 5% rate, not wanting to move and, get a bigger home or do anything and lose their low payment. So there's less velocity and there's a pent up amount of demand of people that actually still would like to buy housing. But can't, because there's just not a lot of stock in the marketplace, and they're back in the renter pool or still in the renter pool.
Right.
All right, we will go to our next headline. This was Jason's favorite one when I sent these over to him today. Is that pickleball attracts another chain plotting nationwide expansion? We talk about a lot about legislation. We talk a lot about the different things affecting owners. We're talking about pickleball today because we've got to figure out ways to use some of these big boxes, Bed Bath and Beyonds, and whatever it may be that have filed for bankruptcy or have closed their doors recently. And pickleball might be the thing that uses those spaces faster than anything. And so I thought we'd talk a little bit about it today. Jason, how is your pickleball game?
I have to be honest. I have only played one time, which you'll probably find very shocking. It is something that hopefully my wife and I are going to get into playing potentially together in certain things too. So I'm excited to get better at it, but I don't play a lot. But I can tell you, in where we live, it is very popular and it is a big thing. And I have been reading this idea for about 6 months now, coming from people, because you have these empty big box stores now that are perfect to put in, 10, 15, 20 pickleball courts. You put in like some locker rooms and some other little things. But remember, like a build out, if you look at the photo you have there, a TI build out of a pickleball facility is not going to be a lot because you've already got the floors. You kind of just either need to refinish them and paint them, which isn't expensive. So it's a low TI deal for the landlord. If for some reason the deal goes sideways, eventually, you're not tearing down a bunch of stuff inside that's unusable because it's still kind of an empty shell. It really does. It works for everybody, and it's a good repurposing of the space. So.
The growth number, 158.6% average growth rate in the last 3 years. It is certainly becoming super popular. Being a little bit older than you are, I remember a time where, the racquetball court, the racquetball center they were all over the place. And, we may be heading back to using some of that retail for this stuff. You can see on that slide, there's a couple different brands that have come out with plans to open facilities. We've got a client, Jason and I do, who has a big, strong interest in pickleball and has been asking us to try to find the right facility for them to do something. And it's going to be a really interesting reuse of space. It also probably attracts some synergistic, tenants to some of these retail centers, and just kind of one of the interesting, reuses of property right now that we are seeing that's going to be valuable additions to some of these, vacant big boxes and get people back into the center that used to go for something else, and then pick something up at one of the smaller tenants. Get those consumers back into centers that have lost a key tenant, which will take us to our next headline. Talking a little bit about retail. Yeah, we've lost a few retailers lately, but I thought this was really interesting. That's that, this slide is basically retail availability in Orange County nears an all-time low. So that orange line and the orange numbers on the left-hand side are the vacancy rate for retail in Orange County, California. The white line is consumer spending, and certainly, the death of retail back in 2020, 2021 seems to be greatly exaggerated, Jason.
I would agree. One of my really large clients is not only heavily invested in retail, but they're doubling down. Like they're buying more and more, and they're really smart capital with a lot behind them. And, you might not need 4 big shopping centers in a community anymore. But if you're the one that buys the one really good one, the one nice one, that one's still going to be there, right, at the end of the day. And to add to this headline, Rick Caruso actually closed a $450 million CMBS loan on the Americana yesterday. So there's clearly still a lot of value in well-located retail. I think people still like to go to shop. And even to your point on the retail with the pickleball is, you go play pickleball and then you stop by, the smoothie bar next door, or, you pick up a bowl from the, restaurant for lunch after, you played or whatever it is. Everybody will benefit, to your point, from just getting foot traffic into the shopping center. And I think that's it's a really good point. And it's the smaller retailers that are really benefit from it.
Yeah, absolutely. I mean, our Long Beach office is situated really in a retail center, and it's probably that retail center that you described a second ago. Like, community doesn't need 4 of them, but the one is it's doing really well. And that's what I see here. We've been in this space for 5 years. I think there's been one tenant change. Their vacancy maybe was for 2 or 3 months, but it's not the retail. It's not the vacuum cleaner and sewing machine shop. It's not the clothing store. It's a couple restaurants where people can go grab a quick bite or sit down and enjoy a drink in an afternoon. It's the tutoring center for kids' education to go along with the dentist and the podiatrist and that sort of stuff. And then a couple quick serve eateries as well. Like, just the makeup of quote unquote retail has changed significantly. And those really well located centers that have synergy amongst the tenants are packed. I mean, you go look at our parking lot right now at 4:30, it's going to be tough to find a parking space. And it's because there's a lot of families utilizing the variety of tenants, getting food for their dogs and their birds, and then going to Lazy Acres to get things for dinner, and then doing all that while one of the kids was getting a math lesson or something like that.
No, absolutely. I mean, it's about having, if you can find that shopping center that has 2 or 3 anchor tenants that have to be there, they're not going anywhere, and everybody's kind of attracted to them, you'll have no problem filling the rest of the space, right? Because people realize how much those anchor tenants drive to the facility or to the property, and then they all benefit from it. So.
All right, let's go to our next one. What we've got here, the headline is "Owners of Distressed Properties Struggle to Find Buyers." Your supporting graph just shows the list to close price gap across 4 major product types, starting to push out a little bit from the lows, from a very tight market in, let's call it the fourth quarter and early part of 22, to now a widening where we're seeing anywhere from 7 to kind of 9% gap between the list price and the closing price. Jason, the headline is "Owners of Distressed Properties Struggle to Find Buyers." My real question for you, as somebody who does a lot of work with lending institutions, is talk about the level of distress you're seeing in the marketplace kind of in general. And then I'd also like you to compare it to what you thought it might be 6 to 9 months ago, where you thought we'd be, and were you on target, or is it surprised you?
So that's a great question. And I had a really long call today with probably my largest client in this space. So I kind of have a really good update on where the market sits. I assumed and thought it was going to only be office space, right? And not, I mean, we've talked about office space before, where you were even like, if you want to get on a 4-story building, Class C, in a decent part of town, you can't get a space. But it's the high end Class A, big time footprint. And I was talking to the client today, and I said, hey, most of what we're seeing out there tends to be the office space. And I go, what would you need to do to buy the office space? And he's like, well, I would convert it to apartments. I'm just going to tell you right now, I'd convert it to apartments, like a high rise, nice office building. I'm going to convert it to apartments, but I need to buy it at a low enough price per square foot in order to be able to put it in and then rent it out and be within the market. So he's like, I would need to buy a Class A building. And a lot of people are. There are some buildings trading at this, at well below $200 a foot. Mm-hmm. And that's one thing that can help solve the housing problem, for example. But then we were talking, and he said, a lot of these Class A new apartment buildings, they were underwriting crazy rents. and they needed to hit these rents, and their loans are on floating rates and other things. So he goes, you're going to see not Class B, Class C, older vintage apartment buildings having trouble. He goes generally, but you're going to see Class A, and we're starting to see some of it. These Class A new constructions, ones that took too long to get to the market, are just coming to the market, and they're going to struggle to hit some crazy astronomical rent. Those are going to have problems, and I think we're going to see that. There was a large hotel operator that instead of getting foreclosed on a $250 million loan, they just gave back 12 hotels to the lender, and they're a successful operator. But, I think the thing to look at is who has CMBS debt. Coming out of the last downturn, a lot of people in, let's just say, the mid 2010s, so 15, 16, 17, were putting on CMBS loans, coming out of the recession, and those loans are usually have 7 to 10 year maturity. So they're all either maturing now or coming to maturity, and the rates are substantially higher. So you'll start to see some, other retail, just because the lenders, they can't make the loans pencil, right, without like cash in. So retail and hospitality, like hotels, you'll see some more of that too. So fortunately or unfortunately, it's just debt driven.
What is your opinion for how lending institutions will handle distressed debt and that process? I mean, in the 90s, they took it all back, sold it fast, at whatever number. In the 2009, 8s to 11s, it was more pretend and extend, and they almost tried not to take things back. What do you foresee being the common path of dealing with distressed debt this time around?
That's an interesting question. So first off, I'm just going to say a general comment, but lenders aren't in the business of owning real estate. So they don't want to own the property. Now, that being said, I think we have a good friend, Justin, a mutual acquaintance, that likes to talk about how leveraged banks are right now and how much money that they have out versus deposits. I don't think the banks can just play the lend and extend and pretend game. I think they have to take the properties back. I also don't think you're going to see a lot of fighting per se. I think it's just going to be, deed and lose, just hand the property over. You might see some short sales if there's still some equity in there, right? Where people are like, hey, they just fire sell it. And then maybe the lender, as part of that fire sale, comes back and gives a new loan to the new buyer, but it would be at a lower LTV, higher rates probably. But I think they're going to take properties back. I mean, you're already seeing a lot of it, people giving them back, people taking them back. You're seeing it's funny. You're seeing big players defaulting on loans. And then you're also reading the headlines that they're raising tons of capital to buy distressed deals, which I find wildly fascinating every time it happens. So,
and we'll maybe skip ahead to that, because I think that is an interesting thing that we are seeing in the market today. There certainly are the distressed headlines. There's, this entity selling this office building at, $35 million when they paid, $96 million. There's some other entity bought a shopping center for $115 million, and they, walk away from it because the debt was, 40, and they walk away. And you're right. Those same places are looking to acquire and looking to redeploy capital in the marketplace.
Well, and remember something, just because the property is distressed in the loan, it doesn't mean the property's not operating well. It doesn't mean it's not cash flowing. It doesn't mean it's not making money. What it means oftentimes, and right now what we're seeing, is the new debt that you would need to replace the old debt, the valuation of the property has gone down because they're appraising it at a different cap rate. the interest rates are higher, so your payments are more, so you can't get the debt service coverage ratio that you need. And therefore the property doesn't make any sense anymore, because the time you bought it based on interest rates, appraisals, and cash flow. And now, appraisal values down, interest rates are up. And while cash flow might be up, it didn't grow necessarily at the same rate as the other two. So,
yeah, that'll take us to our next slide. And I'm excited about this one. So using Orange County again, just some of our stats today. This is apartment sales volume on a quarterly basis. I promise you all that in quarter one of 2023, there actually is an orange bar. It is just significantly smaller than previous quarters and the peak in late 2021. But Jason, you represent a lot of investors, some that are selling and some that are looking to buy. What I want you to do for everybody now is so we have this transaction volume falls off the cliff sort of moment. Clearly, buyers are speaking one language, sellers are speaking the other. Mm-hmm. If you had to summarize, buyers speak today, and then I want you to summarize sellers speak, and hopefully we can tell the world why transaction volumes are down, because people will hear the two different conversations.
Okay, so sellers, it partly with the sellers, it depends on when you bought, right? But sellers generally, if you bought in the last 10 years, they're looking at it and saying, the guy down the street a year ago sold for X. My property is nicer, better, a little higher rents, whatever it is. I should be able to get X plus something, right? And they don't factor in the interest rate environment that we currently sit in and what loans look like. I haven't seen on an apartment building deal, for example, a loan for more than like 55% LTV in 6 months. And a year and a half ago, we were doing 65, 70, 75% LTV with interest only, with benefits. So sellers think that the price that they should still be getting better pricing than they are. And then buyers are frustrated because they're saying, look at where the rates are. And most buyers don't think that the market has adjusted. The seller expectations have adjusted enough to be in line with where the market sits today.
Okay. The follow-up question to that's going to be, so you've got a lot of people that are maybe hopeful sellers.
Yeah.
And then I know you've got some clients that are actually executing transactions as sellers. What are they saying and why are they transacting?
So there's a lot more creativity in the deals right now. It's pretty interesting when we talk about that. I think sellers are still selling for a few reasons. One is separations of partnerships, deaths in families, people, not wanting to own with their siblings or their cousins or whatever it is anymore. People that have bought things so long ago that they've made so much money on it that they kind of just want out of the property. They want newer. I mean, you guys have some phrases that are really catchy that you guys use for this, but like gritty to pretty and stuff like that. They want something newer, fresher, less headache, less maintenance. Maybe they're, kind of disappointed in the way that the government is potentially protecting their rights as landlords or their property. So they in California, so they want to go to, states where they feel safer. People are retiring and moving out of state. They want to go somewhere with no state income tax. Those are kind of the reasons that people are driving right now. Occasionally people are getting, seasoned sellers are just getting their price, but they might have to do something like, I'm going to do a, carry back loan for a year or two at an interest rate that is good, not great, in order to get my price. Right. And that's just a personal choice.
Okay. Next thing, just to kind of talk about and cover, we can kind of stay on the slide. But I heard something interesting the other day. and wanted to see how much you're hearing discussion of it. And it was basically that, a lot of debt that was put in place over the last 3 to 7 years had a fixed period, or I guess we'd call it 2 to 6 years. Had a fixed period. Maybe it was interest only. That fixed period, depending on product, location, all that, is probably somewhere between 3 and 4.75%. And people aren't doing stuff because they've got this debt right now, but the lurking problem that most people aren't looking at is, all right, based on the new index, because it's no longer LIBOR, and based on the spread above that index, what does my rate look like on the current loan I have? And that rate might be somewhere between 7 and 8.5%. And how does that affect the cash flow in 12 months or sooner, or maybe?
Yeah, that's a driving factor for some people when they really sit and look at their loan documents is, do I get out now? Because, I think a lot of us believe at some point rates will probably go back down a little bit here or there. I think, maybe they settle in the 5 range or the high 4s or, whatever it is. But right now being in 7 to 8 range, there's a lot of people that say, there's cash out there right now to buy deals. It's not as much as it was. But if I'm a first mover in the market, when everybody else is in trouble in a year, I already got out, right? People don't like having capital sitting in their pockets, burning a hole. They want to put it to use. So if you're someone that's reasonable and is going to go out to the market, like you said, a year in advance of that loan, you're probably going to be in a better position.
Great. Let's go to the next one. Our next headline is Fed Chair Powell talks 2 more rate hikes and the yield curve steepens. Your supporting graph down there just shows months to sell by product type. Kind of the same thing we saw before. 22, early part of 22, late 21, maybe the quote unquote best data. And since then, we've seen an upward climb to properties sitting on the market longer and taking longer to find the right buyer. Maybe a very simple question, Jason, but if we saw 2 more rate hikes and the corresponding, movement in the 10-year Treasury, as well as in the rates that we see regularly on investment real estate, how do you think that affects the marketplace and how long things are sitting on the market?
I think things will sit longer, especially if the rates are moving upward and with uncertainty. I think if there was more certainty in the market, things would probably move faster because lenders would feel more comfortable. They'd probably feel more comfortable in their spreads, in their quotes. But I think if you have more hikes coming, then I ultimately think you're just going to see properties sit longer. I will remind people, though, the economy is an important part of elections and voting. There's a presidential election next year. And if I'm not mistaken, Fed Chair Powell is a part of the executive branch. So I am sure he will be feeling some levels of pressure from his boss as we approach the election. So,
it just might be a window that we're in right now of where prices corrected a little bit tied to rates, and as rates go down you can get a nice little appreciation bump by buying a good piece of real estate right now.
Yeah, I think one thing you've talked about a lot too is if you buy a good piece of real estate over time, historically you will make money. It will go up in value, right? If you watch the value of your property on a day-to-day or a month-to-month basis, right? Like for your house, if you go on Zillow and you're constantly tracking your Zestimate every month or whatever it is, you're going to see good and bad and you're going to get frustrated and happy. But if you hold it for a long time, it generally has tended to appreciate historically. If I told you could have a 100-unit apartment building in Anaheim 30 years ago.
Yeah, you'd happily have it.
Yeah.
We're not building any more land. Jason, are you one of those guys who checks his Zestimate on a regular basis?
No, I don't. But I know people that love to I have some family members that when I talk to them, they're like, I checked my estimate this week and my house is now worth X. And I'm like, I don't care. It's like it changes all the time, and it's a random algorithm that kind of is a general thing, but it can't tell you actually because each property is unique, So.
Well, we talked about buying a good piece of real estate when you get the opportunity, and that'll take us to our next headline. Interestingly enough, found this article a couple days ago, and while it's not farmland, I had a client call and talk with me about basically solar farming and taking a piece of opportunity zone real estate and building a business around getting a bunch of solar, building car charging, having, employees that would need to go service it, opportunity zone business, opportunity zone real estate, substantial improvement. But this slide, Jason, is purely just about farmland and food. Wanted to get your take on, do you have clients that have actively grown a farm crop producing portfolio over the years? How do they like it? Maybe make some comments on it. I've sold a lot of different things, maybe a couple timber forests, but not a lot of crop yielding acreage over the course of my career.
I can't say I've done a lot. I have one client that has done a few like pistachio farms and a few other types of farms, and he uses like this crowdsourcing website specifically for farm product to raise his capital. And the returns are great. They're consistent, they're solid, they're not overly crazy, but they're 10, 11, 12% at times, right? Like it's not a 20% plus IRR, but it's consistent and it's good and it's stable. I don't know a ton about the space other than I know that we only have so much farmland, and as the population grows and we've sold some of the country has, some of the companies within the country have sold to companies that aren't based in the US, and they export a lot of that product now. So it's valuable in the sense that like we need resources and people are always going to need this. I mean, I think there was an article that a bunch of celebrity athletes pitched in and bought a farm. I have to find the article, but I want to say it was like Blake Griffin and a bunch of other people. They pitched in and they bought a farm for collective $5 million. I mean, I think if you look at some of the wealthiest people in the United States own a substantial portion of farmland. Now you're going to hear people argue that there's one reason or another why they do that, but some of the wealthiest people in the country own huge amounts of farmland.
Well, and if we're going to call farmland wineries and things like that in Napa, yeah, some of the wealthiest people all own it for the benefits that they get from doing that. Adding on this whole thing about farmland, like I think a lot of people think you probably got to farm it. You don't. There's plenty of lessees that lease land to cultivate the crops and do that part of it, similar to if you have a 100,000 square foot industrial building and the tenant leases it out to make or store or move whatever product it is that they specialize in. But a really interesting opportunity maybe for some to use a 1031 exchange to get into an asset class that provides a lot of great tax benefits, but also it can be a pretty passive opportunity in the space. All right, why don't you? We'll skip this one. Jason and I already talked about it. Like, there's plenty of pain in the marketplace, but for every article about pain and distress and whatever it may be, those same groups or somebody else is raising money and positioning themselves to be ready to strike and buy opportunities as cap rates have pushed up a little bit. The slide we've got here, or the headline is commercial real estate prices in the U.S. fall for the first time since 2011. This is a Southern California cap rate trend graph. You can see when we hit our low points, cap rates have moved back up. Although to Jason's point about sellers not adjusting maybe as much as buyers would really hope them to, it's been a very small increase and certainly not an increase on the scale of what we've seen in interest rates rise. Jason, as we have seen cap rates go up, I think one of the things that I find to be interesting right now, just in the marketplace, is that there is still an appetite for people to buy a property where the cap rate might be a little bit lower than the rate that they can get today, because they are buying a high quality piece of real estate, because they are buying something because not everybody is just a flipper and going to go remodel some of the space and then try to sell it real quick. There are a lot of investors that are more 7 to 10 year hold, make my 13 to 16% IRR over that period of time, and they get a chance to acquire a really nice property today that might not be available that day when the market hits the best buying moment over the course of this cycle.
No, I think that's a fair comment. I think fairly priced, well-located real estate is still moving, right? I don't think it has to be a steal. I don't think it has to be, cheap by any means. But if you're well-located and fairly priced, I think people are okay with what we would refer to as negative leverage, where your cap rate is, lower than your interest rate, especially if they're patient or they have a plan, right? And they buy the right piece of property, that maybe they're saying, look, I'm slightly negatively levered now, but I'm going to build these 2 ADUs, and I'm planning on holding it, or I'm going to, substantially remodel all the units. And I know my rents are going to go from, X to X plus 50%. And then I go from, being, a 3% cash on cash return to a 8% cash on cash return. And it's just going to take a little time. And then, when rates go back down, I now go to a 12% or 13% cash on cash return, right? It's about building the value now and getting the good piece of property, knowing that what you can do with it when things get a little bit better.
Yeah, I think that's been one of the most exciting parts about what I've seen our team do lately, is that we've got a bunch of assignments of really nice real estate, like something that over the course of a typical investor's ownership life cycle is property that they'd want to own. And sellers are selling because they're at the age where they want to do something. Their partnership is going, they're planning to be able to go their separate ways and leave to different kids and not have some of the entanglements, or they just see opportunity where they can, we've got a number of really well located LA assets that are perfect for somebody who's going to really actively manage them the way that the big corporations manage property, and somebody will be real successful. But the seller, on the other hand, has a 35-year career of doing it totally different, doing it in partnership with the tenants, keeping the rents a little bit lower, not passing along every expense. And now it's just gotten tiresome for them. And they can actually, instead of having to fight that uphill battle every day, take their money and move it into something that's just a little bit easier, that works out better. But Jason, let's maybe end on, we got a couple minutes left. Let's talk about some of the interesting opportunities and things that we're both working on. What are some of the deals that you're working on that are that you look forward to getting that call and be able to focus on that deal because it's just fun or neat, or there's something interesting about it?
So I think we're seeing a lot of people that are doing these bridge to a longer term program right now. I think people there's a lot of, shorter term lenders in the market right now that are, hey, I need a little more leverage, or I just need something. This lender believes in your business plan. So I like those kind of deals right now where it's like, I'm going to buy this property. The property doesn't really have a lot wrong with it, but I can improve the value, but I'm going to need a year. And when I do it in a year and I cash you out, I might need 70% loan to value right now, plus, some construction costs. But when I cash you out or when I refi out the other lender in a year, I'm going to only be refining at 50% LTV, right? So they know they're going to grow. So I like how people are thinking through ways to reposition or improve values of properties up front. So they're going in with a plan of, I'm going to buy this on bridge, and then this is going to be my execution. And as long as they're reasonably underwriting the takeout execution in a year, there's really good deals out there. You just have to believe in your team's ability to execute on it.
Yeah, I would concur with that. That there's a different layer of lenders. It was so easy to go to a big shop and get a low rate for a number of years, but now the creativity to get it done, to wanting to roll up their sleeves to understand how it's going to get done. There is a lot more out there, I think, than people see on Main Street when it comes to financing a deal and figuring out ways to get it done. Whether it is these kind of newer lenders in the space, or it's even the seller getting involved and carrying some paper or all of it in order to facilitate a price or get the transaction done, so that so that deals do get done. As we finish up, we're kind of in the last minute. Any other exciting project that you're working on that you really like right now that you think is cool that you can talk about?
I like when people pick up the phone and they say, I need to sell this property and I want to buy something in a different location. And they're like, I've heard you say this for a year or two or three. And I didn't think the market could, not the market, but I didn't think the environment in the area could get worse or whatever. And it's continuing to deteriorate. And so I like helping people with that kind of stuff. So it's interesting because, at some point you think it's got to stop, but then you don't know.
Yeah. And I think for the most part, people just hope that it's going to stop, and it's hope that it's not going to be as hard because they've spent a lot of years there. It's been good to them. It's what they know. But when you take a step back and you're not quite as invested, like where we kind of get to sit in these scenarios with clients, you can really see the pain and the things that frustrate them. And you can figure out a way to make it easier for them or make it better or just not as painful. And those things, you're right. Like whether the market's on fire or the market's maybe the way it is today, there are always opportunities to find a solution that helps them. And it's the fun deals to be a part of. So, and we, truthfully, for everybody who's on the call and watching us today, we do have the great opportunity to do a lot of work with Jason, where we work with a lot of clients exactly on those projects, moving money to different products, moving money to different states, to help them meet their goals. Jason, it's always a pleasure to have you on the call, to share your insight. You covered a bunch of stuff today, gave us a couple nuggets that I don't think anybody expected. And as always, thank you very much. It was a great time.
Thanks for having me. Looking forward to doing it next month.
Cool.